Choosing the right state for your retirement is a big deal. It's not just about picking a place with good weather or where your friends live. What works for one person might not work for another. Your retirement is unique, and the best state for you will depend on your personal situation and financial goals. There are many factors to consider, and each one can make a big difference. Federal tax rules for retirement income are pretty straightforward. However, state rules are not. When looking at retirement taxes by state, in thinking about where to retire, you need to look at more than just the state income tax rates. By also looking at property taxes, inheritance and estate taxes, Social Security benefits taxation, and state and local sales taxes, you can make a more informed decision. Each of these factors can have a big impact on your overall financial picture, so it's important to do your research and choose wisely. Each state has its own rules and regulations for things like IRA withdrawals, pensions, and 401k distributions. Let's break it down so you can make the best choice for your retirement years. 1. State retirement income taxes. One of the first things you might want to consider when looking at the best states to retire for taxes is how a state taxes retirement income. Some states are more friendly to retirees than others. Depending on where you live, you could pay as much as 12% of your annual income in state and local income taxes in retirement, or as little as 0%. The average American pays 2.1% of their annual income in personal income taxes to their state, though the percentage varies greatly depending on the state where you live and the type of income you earn. To put it in perspective, suppose you move to a state with an average 2.1% income tax, and your taxable retirement income is $100,000. That's $2,100 in additional income taxes in retirement, above and beyond federal income taxes. Put another way, if you could avoid that tax, you would have an additional $175 monthly to spend or save in a high-yield savings account. There are currently 8 states that do not have a personal income tax or a retirement income tax. Those states are Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, Washington, and Wyoming. A 9th state, New Hampshire, currently taxes interest and dividend income above $2,400, but that tax is currently being phased out and will be repealed beginning January 1, 2025. 2. Property taxes and real estate costs. Next, when scrutinizing retirement taxes by state, it's also important to look at property taxes and real estate costs. Sometimes states with low or no income tax, like Texas, make up for that loss in revenue by imposing higher property taxes. This means that while you might save money on state income taxes, you could end up paying more in property taxes. So when evaluating retirement taxes by state, it's crucial to consider the overall tax burden, not just one aspect. As you can see from this table, the states with the lowest property taxes are Hawaii, Alabama, Colorado, Nevada, and South Carolina. But remember, the cost of living in these states can vary, so consider this factor in your decision as well. Homeowners in Alabama, for example, may pay less per year in property taxes than Hawaiian homeowners, because most home values in Alabama are lower than those in Hawaii. In addition, 26 states, including Alabama, Colorado, Nevada, and South Carolina also impose an annual vehicle property tax, which taxes your vehicle based on its value. The average American household spends $2,869 on property taxes for their homes each year, according to the U.S. Census Bureau. And residents of the 26 states that incur vehicle property taxes shell out another $448 on average. 3. Estate and inheritance tax. If you're planning to leave something behind for your loved ones, inheritance tax planning and estate tax planning important to consider when assessing retirement taxes by state. States like Texas don't have an income tax, but they do have other taxes that could affect what you leave behind. The estate and inheritance tax can significantly impact the amount your beneficiaries receive. Although all states have a federal death tax, you can see from this map that there are currently over 30 states that don't have estate or inheritance taxes. It's worth looking into the states with the lowest estate and inheritance taxes to ensure you can pass on as much as possible to your heirs. 4. Social Security tax. Another thing to keep in mind with regard to retirement taxes by state is how a state taxes Social Security benefits. Although Social Security is generally taxed at the federal level, based on your total retirement income bracket, some states do not tax Social Security income. You can see the breakdown by state in this table. This can be a big relief, as it means more money in your pocket each month. As you can see, some states such as Colorado may tax a portion of your Social Security benefits depending on your total income. So when weighing your options regarding the best states to retire for taxes, knowing which states do not tax Social Security benefits can help you maximize your retirement income. 5. State and local sales taxes. Finally, don't forget about state and local sales taxes when examining retirement taxes by state. Retail sales taxes on goods and services are an essential part of most states' core revenues. On average, they make up approximately 28% of state tax collections and 13% of local tax collections, or 24% of combined collections. These taxes can add up, especially if you plan to do a lot of shopping or have discretionary income. States with high sales tax rates can impact your retirement spending and should be factored into your overall planning when looking at the best states to retire for taxes. For example, states like Tennessee have high sales tax rates but no income tax. On the flip side, states like Oregon have no sales tax but have high income taxes. 6. Making the right choice for you. Choosing the right state for your retirement is about more than just picking a place with nice weather. It's about considering all the factors that will impact your finances. Let's compare retirement taxes by state for a newly retired couple who is deciding whether to move to either Florida or California. They make a combined $60,000 in annual retirement income. They generate a combined $40,000 a year from their IRAs and pensions, and another combined $20,000 a year from Social Security income. They will be purchasing a $500,000 home and expect to incur $40,000 in total expenses annually. If they lived in Florida, they would pay $4,150 a year in retirement taxes, whereas if they lived in California, they would pay $6,200 a year in retirement taxes. Therefore, they would pay almost 50% more in retirement taxes living in California than they would in Florida. In summary, Florida offers a lower overall tax burden due to the absence of state income tax and a lower sales tax, although property taxes are slightly higher than in California. In contrast, California's state income tax and higher sales tax significantly impacts the total tax burden despite somewhat lower property taxes. Happy retirement!